In part one of this chapter, we're going to talk about the valuation process for determining what you might be willing to pay for a stock. But in the corporate context, thinking about managers, as we're going through this chapter, try to envision what could you do as a manager to help increase the value of the stock. So we need to think about the variables in place and how management's decisions ultimately have an impact on the valuation and how investors value stock. So let's think about a 1-year investment, right? So if you're a 1-year stock investor, this is what you expect to get. You expect to pay for the stock, that's P sub 0. You also expect at the end of the year, you're going to receive a dividend, D1, and you're going to receive, again, the stock of the price that is at the end of the period. So we need to find or equate the values here. How do we look at the value? Is this price the correct price? So we need to have some form of discount rate. And since cash flows of stocks are risky, we don't want to discount it at the risk-free rate of return. And since we're talking about stocks, we're going to equate it or use the equity cost of capital for the company. So the value of a stock today is next year's dividend, the dividend at the end of the year, plus the price at the end of the year, divided by, this is the cost of equity. So if the current stock price were less than this amount, we would expect investors wanting to buy it, right? This is what the value is. If the stock price is less, people would want to buy it. If the actual price was less, people would want to buy it. And of course, if the price was more, people would want to sell the stock. Again, the idea is we're assuming that the value we place, the P0 here, the value we place on it, we assume is correct. We have information, and we're using that information to come up with this particular price or value. If we do a little algebra, we can solve for the rate of return. The rate of return on the stock has two parts to it. Part of it comes from the dividend yield, next year's dividend divided by today's price. And of course, there's a capital gains that we could earn, which again is the difference in price divided by the current price. So this cost of equity, or the return on equity, comes from two parts. And this makes sense. You realize that when you buy stocks, there's two ways you make money. You make money from dividends that you receive, and you make money from receiving value when you want to sell the stock, right? So again, as a general guideline, right, we know that the expected total return of the stock should be equal to the expected return of other investments that are available that have equivalent risk. Again, this is our general view, right, that things of equal risk should have very similar rates of return. So let's suppose we have Walgreens stock here, pays $1.40 in dividends at the end of the year, and we expect it to sell for $80 at the end of the year. If the investments are equivalent risk, or getting 8.5%, what would you pay for Walgreens stock today? Well, our basic formula, D1 plus P1 divided by 1 plus the cost of equity, right? So we would expect that Walgreens stock should sell roughly for $75.02. That $1.87, or excuse me, the dividend yield based on that price is 1.87%. The capital gains that you get on this, obviously the change in price, it would increase to $80 from $75. That's $4.98. So the capital gains on the stock would roughly be about 6.63%. So that total return is the 8.5% that we assumed that this stock would be worth. So this company's, again, its returns, its total returns, some of it comes from dividends and some of it comes from capital gains. So let's expand this to a multi-period model. Look at a longer version. The dividends, this is known as the dividend discount model. We need to know the present value of all of the dividends up to period N, plus we need to know the price at the end of the period. So again, if you notice, R sub B here is the cost of equity. One of the assumptions we're going to make is that this stock has an infinite life. So we really don't need the price at infinity, because the present value of anything at infinity in today's dollars is 0. So this final expansion here just says, look, you need to know the present value of all the dividends from now to infinity. Now the challenge is obviously calculating that to infinity. But mathematically, that formula simplifies to this, which is something that's actually referred to as the Gordon model. The Gordon model says that the dividend next year divided by the difference between the required return on equity, right, the cost of equity, and the growth rate of dividends, that will equal the value of the stock. And of course, we can expand D1 to be today's dividend times 1 plus G. So the value of the firm depends on the current dividend level, the cost of equity, and the growth rate. Now this is the growth rate of future dividends, right? It's not the growth rate of past dividends, it's the growth rate of future dividends. You're not going to receive the dividends from the past. You're only going to get dividends from today moving forward. Now we have a worksheet that will help us with a lot of these valuation principles, if you will. But here's a company, Con Edison, right? Plans to pay $2.36 in the coming year. Now, if you read that, that is D1, right? It's equity cost of capital 7.5%, and dividends are expected to grow by 1.5%. So if you look at this worksheet, there is a cell down below that says if D1 is given, you enter it here. So this is where we would put the $2.36. Now I will caution you, after this problem, you need to delete this after you do this kind of a problem, because it automatically fills in up here, right? So we enter the data. The value of this stock is $39.33. So what if this stock had a price of $59? Would you pay $59 to get $39? And the answer, of course, is obviously you would not. However, if you did buy this for $59, you would earn a return of 5.5%. How much did you want to receive? Well, since this is a stock, you want to get the return for this particular equity. And you wanted 7.5%. So this investment actually is a bad investment, because you don't get the rate of return that you want based on the riskiness of this equity. The XYZ Corporation recently paid $3. That's the current dividend. Dividends grow by 7%, and the cost of equity is 16%. Plugging those numbers in, we get $35.67 for the stock value. Now notice down below, when you're told what the most recent dividend is, that goes in this box here of 3. So that the formula for D1 is the current dividend, $3, times 1 plus the growth rate for the first year. Again, $35.67. If the stock's selling for $37, you wouldn't pay $37 to get $35. So it tells you not to buy this stock. But if you did buy it, you'd earn roughly 15.6%. However, for the riskiness of this investment, you wanted to get a minimum of 16%. So again, this is a stock that we probably do not want to buy. So here's a quick little question then, right? AT&T plans to pay $1.44 in the coming year. Equity cost of capital is 8%. Dividends grow by 4%. What's the value of AT&T? Again, plugging into our formula, we can do this quickly. It's fairly easy math, right? It's $1.44, next year's dividend, divided by 0.04. So this stock would be worth, again, $36. So now let's think about how we come up with some of these variables. And we're going to concentrate now on the dividends, right? We want to look at dividends and growth, right? How does this all play together? So there's a simple growth model of growth, right? The dividend payout ratio. So the fraction of earnings paid as dividends each year, right? It's the dividends, right, equals the earnings divided by the shares price divided by this payout rate, the ratio, right? So how can we impact the dividends that are paid? How can we generate more dividends, right? Well, there's really a couple of things that we can do to increase dividends, right? We can increase its earnings, or we can increase the payout rate. So again, let's just take a look at this one more time, right? How can you then, right? How can you affect earnings, right? What does a company do with its earnings, right? So we can either pay them out as dividends to its investors, or it can retain and reinvest them. Well, if it's reinvesting them, they're going to earn a rate of return. And that's where we're going with this idea. It says, look, based on the amount of money that a company retains, it reinvests that and it earns a rate of return on its investments. So we want to talk about that. Increase in return is the growth rate of earnings and the growth rate of dividends. So the change in earnings of a company is the new investment times the return on new investment. And the new investment obviously is the earnings multiplied by the retention rate. Again, this retention rate is just the opposite of the dividend payout ratio. So if you if you pay out 25% of your dividends, that must mean you retain 75%. And that retention rate is it would be 75%. So the earnings growth rate is the change in earnings divided by the earnings. Ultimately, then that boils down to it's the retention rate times the return on new investment. So again, our equation here, the G in our formula for dividend valuation, we take the retention rate and multiply it by the return on the new investment. So what is this return? If we assume that the company is going to maintain similar profitability, we could use the return on equity, the ratio that you can calculate, which is just net income divided by common equity. You figure that ratio, that's the number you would use there. So if a company keeps the retention rate constant, then the growth rate in dividends is going to be equal to the growth rate in earnings. So again, we were always asked, how are dividends and earnings related to each other? right? They are a piece. They are related to each other, and one certainly can calculate dividend growth based on earnings growth, but we have to make an assumption. And that assumption is that the managers of the company, the board of directors, are always going to retain the exact same amount. If they change how much they keep, that obviously changes the amount of dividends that they keep. And then this equality will no longer hold. So let's kind of see if we can bring this down to a moral of the story, if you will. If a company wants to increase its share price, should it cut its dividend and invest more, or should it cut investment and increase its dividend? Again, since the first thing affects the growth rate and the second thing reflects the increase or the change in dividend yield. Now, the answer depends on the profitability of their investments. Cutting the company's dividend to increase investment will raise the stock if and only if the new investments have a positive net present value. So if we're generating more value for the company, investing in those things are going to increase the value of the stock. And if you have to do that by using dividends to pay for it, it kind of makes sense that that might work. Now, in reality, in a later video, we will talk about dividend policy, and it's far more involved than just this basic question here. But the increase in investment and the rise in price, this is true if and only if management tells investors why they're doing this, right? If a company just reduces its dividend to buy things and they don't tell you what they're buying or give you some kind of a clue that this will increase value in the future, since you have nothing to work on, you have to assume that for some reason they need that money and you don't know why. It could be a good reason, but it could also be a bad reason. So again, this moral of the story is true if and only if there is information about why they want to increase value. So I've gathered some information about Molson Coors. The ticker symbol here is TAP. So what I've gathered, I have the risk-free rate, I have the rate of return on the stock market, I have the beta for Coors, I know what their dividend yields, I got this from Yahoo Finance, return on equity, again, I got that from Yahoo Finance, dividend payout, I got that from Yahoo Finance, and these dividends I gathered from a historical download of dividends over the past several years. And I did this from 2008 to 2012. So here are the dividends. So what we want to do is we want to input that data into our spreadsheet, right? So let's first start with the rate of return. Here's the information that we have for rate of return. It says K sub S here is 11.42%. So that's nice. We have the stock price that's input in this yellow box. We have the expected, we don't know what that is yet. But if you put in the price, this ultimately is going to calculate the growth rate. So capital gains for this stock, based on this information, says that the capital gains are going to be around 6.5%. Where did we get that? That number comes from up here, the G, the growth rate. Where did I get that number? Well, down below here, we have some information. Here's the dividends, the time value calculation for growth on dividends. It turns out that the growth rate is around 11.1% if you use time value. If you use the other information, the retention ratio and the return on equity, it turns out that they say the growth rate is about 2.13%. If you take the average of those two growth rates, that's roughly around 6.5%. So when you do that, the 6.5% plugs in to our case of S formula here, and that's about 9%. So we have two values for growth of dividends. We have two values for cost of equity. So if you take the averages, that's where we end up with this 10% cost of equity, and G is the 6.5%. We know that the dividend, we know what the value that is. It's going to, next year's dividend is going to be $1.36. So this stock has a value of $38.95 using this dividend valuation model. Compared to the stock price at this time of $53.20, you can see that the stock price appears to be, to a great extent, overvalued, right? It's too high based on the information we know about the company. So what do we need to know about growth rates here? We can't use this growth rate model if the growth rate isn't constant. So that's really the first step here. Is the dividend constant? For some companies, young companies, they have fluctuating growth rates. Think about a company that is innovative. They have a new product. So when they invent this new product and they start to sell it, essentially they have a monopolistic opportunity on selling this product. So they're going to have extra high returns on that product. However, eventually somebody's going to figure out how to create that product and do it cheaper. So eventually the company will have to bring its prices down, etc., so that the growth rate will change in the future. So we have a model that you can use. It's called the Supernormal Stock Valuation Model. It's a worksheet. And again, we have this product, right? It says it's going to be able to pay dividends at an above normal rate of 12% for the next 4 years. After that, the growth rate is going to go back to the industry standard of 9%. The most recent dividend was $4.25. Required return on this company's equity is 20%. What is the value? So again, plugging our numbers in here, we don't have a stock price. We don't need that. But the value of this stock, we find here is the present value of the first 4 dividends. It then also calculates the value at the end of the time frame, and then it calculates the value of the combined present value of the dividends plus the present value of the price at the end of the 4 years. So this stock would have a value of $46.31, right? So again, we have two models. One assumes constant growth and one assumes a growth rate that changes. In a more complicated version of this variable growth rate model, we could have it changing more frequently. That's a little bit above my programming ability, but it shows us that there are different kinds of stocks with respect to growth rates. So there's a tremendous amount of uncertainty with forecasting dividends in the future, right? Small changes in growth rates can lead to very large changes in stock price. So we do have to be very careful about how we change and how we utilize this dividend growth rate model. It's very popular. It's not that difficult to apply. But as with all models, there are weaknesses associated with it. So that's the end of part 1 of the stock valuation chapter.